Richard Reyes, the financial quarterback, and this is part 2 of Diversification is Your Buddy. Part 1 is actually down below in that link if you haven't been able to watch it or you want to watch it for a second time. And it's also part of our book, The Dirty Filthy Lies a Broker Taught Me and 101 Truths about Money and Investing, which you can actually get our book down below on the link to the book. Okay? So as I stated last week, the word diversification as well as asset allocation is a very important part of investing, but it's a very commonly misused financial term, not only misused by investors, but misused by the financial industry itself. Diversification simply is the concept of not putting all your eggs in one basket. Okay? We know that this sounds like kindergarten lesson, but you need to bear with me because although it seems like a basic foundation of investing, I will tell you that 90% of the people that come through my office are poorly diversified, and this is very risky. Okay, so case in point is a person that came to see me a few weeks ago, and he had told me that he's heard all about diversification, asset allocation. He practices it religiously. He understands it, but he wanted a second opinion in his portfolio, and this is what he provided to us. He had about 30% in cash, 30% in these big name stocks: IBM, Microsoft, Bank of America, Citi, AT&T, and Johnson & Johnson. And then he had another 40% in municipal bonds, of which actually half of those municipal bonds were in a municipality that was right here in Florida. So, is this person diversified? Well, from the basic description of diversification, sure, he was diversified. But I will tell you that he was extremely poorly diversified. One of the major components of diversification is what's called proper asset allocation. Your portfolio is properly diversified when you own asset classes, asset categories with price movements that do not mimic each other. Allocating your assets wisely and prudently over widely divergent asset classes is the key to preserving and growing your wealth. Now, let's think of asset classes as ownership of groups of different size and types of domestic and international stocks and bonds. Okay, for example, domestic large cap growth, domestic small cap growth, domestic large and small cap distressed company, or what often called value companies. How about micro caps, which are extremely small companies, smaller than small cap companies? Okay, and all of this, of course, not only domestically but international. And you combine this with adding a combination of domestic and global bonds as well. So an efficient portfolio actually incorporates the important concept of asset allocation for 2 reasons. Number one, folks, no one, absolutely no one, and I tell you this multiple times, no one can predict returns. Okay? Many asset classes are dissimilar. They're dissimilar to one another. They move independently of each other and have different market cycles. So when one is up, one is down, one is down, one is up, and so on. So number 2 is, by incorporating proper asset allocation, you are actually able to design a portfolio that by combining these various unique asset classes, the risk and correlation vary. So you can actually build a portfolio whose risk diminishes, actually goes down, and whose return actually goes up over time. So how many stocks do you need? Okay, is this enough? Well, broadly, prudent diversification is the answer. So when you ask about how many stocks we need, well, it's not uncommon to have about 12,000 individual stocks over 50 plus countries and various types of asset classes in your portfolio. Actually very few investors actually are wise enough to do this and to have proper asset allocation. Now, if you are not our client and you need to review your portfolio, you need to call me or email me. And let's get together and finally get this figured out for you and get you heading in the right direction. Because remember, folks, like I said before, 92% of your portfolio's return is actually determined by this, and it's very important for you to get it right. See you next time on Financial QB TV.